Hey guys, RC Peck here with Fearless Wealth. So look, this week's title is The Market's Down 29% in 1 month. Now, I'm talking about the S&P 500 specifically here, guys. So now what? Now what do we do that the market, like we can just round it and call it 30%. So we have a lot to cover. Let's get into it because times like this are important. Okay, guys, disclaimer, you can see the whole disclaimer at fearlesswealth.com / legal disclaimer. Guys, this is opinions. Get investment help, support. Investing can create a lot of loss if you don't know how to do it properly. So please, please don't take any of this as advice. Okay, here's what I'm going to cover. I'm going to cover three things, guys. I'm going to cover business models matter, but price matters more. The first one. Second thing I'm going to cover is corporate bonds broke. They actually broke. They're not breaking. They broke. That's past tense. Here's what's next. And then last, best case, this is just like 1987. When you're done watching this, this is what you're going to take away. Price matters most. It's going to get worse. There's a bailout coming to corporate America, not just to banks, but to actual corporate America. What recovery actually looks like, best case recovery, and seeing what is happening is most important. We are taught to close our eyes and turn our back to the markets. So let's jump into this. So from an observational point of view, I like crashes because I want to see what happens. First of all, guys, crashes happen whether I like them or not. If you don't like the word crash, because I know it's kind of hypey, 20, 30, 40, 50, 60, 70% falls in the market right now. I'm using round numbers. We're down 30%. Each country has its own number that it's down. Each way the stock market is measured and managed depends what index is down at different rates. But generally speaking, we're talking about 30%. So look, Kroger versus Amazon, right? Two very different business models. The blue line on the price chart, that's Kroger. Now, Kroger's been up or is up 48% since June of last year. So that's pretty good, right? June of last year, Kroger, even before COVID-19, Kroger hopefully was starting to figure out, the grocery business is $800 billion a year, $800 billion a year. We've got a bunch of grocery stores. Let's figure out how people can order online and just pick up. Just come up to the drive up, pick up, and we'll get it for you. So I'm kind of rooting for Kroger's and all the different QFCs and whoever they own, whatever the different company names are, grocery store names. And I put it in contrast to Amazon, which is supposed to crush everything on the planet. During the exact same time period from June of last year, Amazon's up 8%. Now, guys, I'll say to you, Amazon is doing very, very well since February 19th, which was the peak of the U.S. stock market. But again, it's still down because the 19th is about here. That's about the 19th. And you could see that coming into this, Kroger was moving up. And Amazon was going a little sideways, broke out, but then fully corrected down. And yes, Amazon's doing better, much better than most other companies. Now, look, Amazon's going to come out their earnings during next quarter, and they're going to probably absolutely crush it. I'm just simply pointing out that we are going to see companies step up, and we are going to see companies fail. And unfortunately, most of the way people have been taught to invest is to read words and letters and text, and because it's all confusing and jargon, they use a rule of thumb, also called a heuristic, which is also known as a shortcut. And so what they do is they say, well, I just got to find someone I trust. But what happens is they end up getting into some other person's business model. One of the best things you can do is to get trained to think visually. The next comparison I want to make is McDonald's versus Chipotle. I think I spelled Chipotle right. I did it from memory. My kids love Chipotle. By the way, my kids have never been to McDonald's, never been in McDonald's, never been through a drive up to McDonald's, never eaten McDonald's before. And I have 9 and 12-year-olds, a 9 and a 12-year-old. So look, McDonald's, since February 19th, is down 30%. Chipotle, which has no drive-up windows, is down 43%. So again, we're going to see some shakeout. We're going to see some shakeout in the market. That's what market corrections do. They pick winners, they pick losers. Companies are going to go out of business. Companies are going to fail. Guys, I don't mean like that corner store company. I mean like the big ones. Fortune 1000 companies will go out of business. Absolutely. I'm simply pointing out to you right now how McDonald's got drive-up windows, so they can continue to keep the lights on and serve people, and can continue to get even better and better at figuring out how to have people come up to a drive-up in, I'm sure, some beautiful looking screen and order even more. I did read a bunch of articles that McDonald's, when they're starting to look at the weather. So when the weather changes, they promote different items on their big screen menus. But we're going to see how different companies do, right? Chipotle does not have, I guess you could do takeout if they allow it, but there's no drive-ups for Chipotle. Yes, you can have some DoorDash do it, but I doubt that's going to be happening a lot. And here's the last comparison that is just absolutely fascinating to me, guys. The world versus the UK. So the world learned about the first case of COVID-19 on December 31st, when the Chinese government let the World Health Organization know they had their first case. So that's why this starts on December 31st. The blue line is the world stock market. So this is the whole world, including the US, the UK, Europe, everything. And that's about 29%. The UK is down 40%. So this is going to be really interesting. Now, if you don't understand why I have the UK up, the UK is basically saying, look, guys, we're just going to go on with our life. We're not going to quarantine. We're not going to socially distance. We're just going to do our own thing. We don't think we can stop this thing. We're all going to get it. And we're going to just take this approach, and it's not going to affect our economy as much as just shutting everything down. Now, I don't know which one's right. I don't know which is the right way to do it, but the price does, and we're going to follow this and watch this. Again, guys, here's the takeaway. Price matters. What matters most is to be a student of price, to learn how to think in price, not learn how to think based on the year you were born. Or, guys, something's wrong when you call up your big box advisor and they say, we just got to ride it out. We just got to ride it out. No one wants to ride it out. You may have wanted to ride it out, or maybe you did ride it out in 08. That was 12 years ago. If you're 62 now, you rode it out at 50 when you were in the peak of your earnings. At 62, you're looking for the exit so you can have the choice to not have to work anymore. You don't want to ride it out. Plus, I'm going to give you the best case scenario of what ride it out is. I'll also tell you what the worst case scenario is. Worst case scenario is not good. Guys, you don't want to ride it out. If anyone's told you that, it just makes my blood boil. There's a better way to manage. There's a better way to manage your life savings than just to ride it out. And I'll talk about that. Okay, guys, the next thing I want to make sure I covered was investment grade bonds. These are investment grade bonds. Now, LQD is a ETF that tracks investment grade corporate bonds. It's an iShare ETF. So we get to go back to 2002, which is good enough data because at least we get the 08 crash in here. Now that's Lehman Brothers right there. Now this fall right here and this fall right here are the exact same price fall. That's pretty interesting. Now, going back to 08, this price fall happened in October. This is investment grade price chart. This is not the stock market itself, right? The stock market did not bottom for 4 more months. So Lehman, I'm going from memory, happened, I believe, in October, maybe September. But let's say October. The market bottomed 4.5 months later. The stock market kept falling for 4.5 months. So these big events do create some reasons for the market to slow down, from the sense that the Fed's going to act, Congress is going to act, we're going to get some legislation out, people are going to get checks in the mail. In 08, my operations manager, Michael, actually reminded me that Bush sent out checks to everyone. We're going to get checks in the mail. They're probably going to be bigger. I hope this time the government bails out individual people and not corporations. I would love to see them send a check for $5,000 to everyone, every adult. Don't know what that would look like or how that would be done, but they have all of our addresses. So we've got a Lehman Brothers collapse in investment grade bonds right here. Guys, companies are going out of business. I don't know which ones they're going to be specifically. I'm just going to pick out one, just one company. And the company I'm going to pick out is a company called Boeing. Now, I picked out Boeing for a couple of reasons. One, it's not too far from where I live in the Seattle area. I think they officially moved their headquarters to, I think, Illinois. Is that right? The worst run state in the country? I'm sure they had their reasons. I'm not sure where their headquarters is. It's not here anymore, but they make all the big things here. Not just here, but they have two huge plants here. So obviously Boeing got into some problems when their Supermax 8 started crashing. That has not been resolved. But boy, oh boy, Boeing is down 78%. Now, guys, this is Boeing. Half of the commercial jets are by Boeing. 90% of the freighters, the air freighters, are by Boeing. I mean, last year, in a crappy year for Boeing, they still did $77 billion in revenue. $77 billion in revenue. Like, that's a real number. And what you see here is a company collapsing because they took on a lot of debt, and now they can't service their debt because people aren't buying their planes. Right? How many more companies are there? And guys, I'm not saying this like zero hedge, gloom and doom. Oh, I got a newsletter to sell you. But there's a problem. And I know people are starting to bottom fish. I'm hearing people like, oh yeah, I went in, I got some in there. Guys, bad idea. I call those hero trades. Those are hero trades. Some people call it catching a falling knife. Some people say catching a bouncing falling knife. Put your metaphor in there. It's a bad time to start to dollar cost average in. I think that's a mistake. This is very likely of getting worse. And I don't necessarily say that, I mean, I don't know how far the market's going to fall. Right now it's down 30%, depending on what market you're looking at. Like 30% is a really, that's a legitimate fall. But in 08, the market, S&P was down 58%. .com was down 49%. 87, it was down 33.5%. 1974, we're down 49%. And then I'm just keeping out all of these sub 20% falls. And of course, guys, those are just the US stock market corrections, which I studied every stock market correction of 20% more going back to 1900. So I'm pretty familiar with how these things look. And they typically get worse. Now, one thing is we don't really know how this one's going to act. This one's going to be very different, but the closest thing I have to this right now is 1987. So if you look at the screen, this is 1987. Now, let me tell you what's similar about 87 till today compared to today, and let me tell you what's different about it. So the first thing is the speed. The speed. I took the last 50 years of market corrections that were 30% or more. And the 1974 one took 21 months to go top to bottom. 21 months to go top to bottom. Lost 48 or 49%. And every month it lost about 2.3%. I'm going to do this monthly loss thing for you. The 87 crash lost 12% a month. The 2000 crash lost 2.3% a month. The 08 crash lost 3.4% a month. So we've got, of the last 50 years, 3 of the 4 crashes on a monthly, 2.3, 2.3, and 3.4. I didn't add them up, but let's just call them all 3% for super. It's actually 2.5, 2.6%. And then the outlier is the 1987 crash. The one we're in right now, we're down, again, I'm measuring it from the S&P, we're down 29% in 1 month. Like, that's amazing. 29% in 1 month. That type of destruction takes time to heal. Okay, that takes time to heal. That doesn't heal over a weekend or a week, or the Fed dropping rates to zero, or saying they're going to print 1.5 trillion or 500 billion or whatever the numbers are that they're coming out with. That just doesn't stop the correction, okay? And the U.S. government is going to come out with some sort of fiscal plan to send people checks, something like that. It's going to happen, but it takes time. So what I want you to see from the 87 crash is a couple things. One, this was just a stock market crash. If you look over here, bonds were down coming into this crash. Bonds were heading down for 18 months. Cash was heading down for 34 months coming into the 87 crash. And commodities were down 45 months coming into this. So no money was going into commodities, no money was going into cash, nobody was going into bonds. Even when this happened, it happened so fast, money didn't really move anywhere. What I also want you to see here is there was a lot of back and forth, right? So you got the huge 33% fall, of this 33 percentage points, 22.5 happened in one day. And we got two more retests. Now, I've heard a lot of misinformation out there, and I think someone said, it was corrected in a year. So here's the recovery for the 1987 recovery, and it's 39 months. Now, I want to tell you how I got to 39 months. Now, you can clearly see visually that the green bar goes to here. So here's my measurement of correction. Now, I did not adjust for inflation, and this is the S&P index, so dividends are not included. Okay, but to me, a recovery is finished, or we are recovered, when the price breaks above the old high and it stays above it. So it did not stay above it in 89. It did not stay above it in 90, and it came back down. And I guarantee you this scared the hell out of people. Notice it actually bounced off this and came back down. Okay, then right here, it broke above in 91 and then took off, and we had the 90s. So best case scenario is we get back to highs. Again, this is just the index. I'm not adjusting for inflation, and this does not include dividends. So I think best case, if this is it, if we just dropped 30%, I know the S&P's down 29, Dow Jones more, small cap, oh my God, bloodbath. Other parts of the world even worse. But right now it's looking like I'm going to call it 3.5 years. But here's the thing. We don't know. We know we're in recession now. This is the interesting thing about the correction we're in right now. We know we're in it. And the U.S. is about a $20 trillion entity. So by shutting down the country and restaurants and schools and whatever else is getting shut down, did that cost the economy $1 trillion? Like 5%? Right? And we're going to have a GDP down 5% this quarter. Did it cost $1 trillion? Right? Because supposedly 70% of our GDP is spending, is consumer spending. Right? So when that basically gets shut down, when unemployment, I forgot what it bottomed at. I didn't forget, I actually didn't look. 3.5%. What does that shoot to? 7%? 10%? Again, I'm not doing Chicken Little. I'm having a conversation. I'm thinking out loud, like, where does that unemployment go? It doesn't go down. Okay. It's going to go up. And so we don't know yet, but best case scenario is 39 months. But still, we still don't know all the pain in the system. And if any of you have been tracking any of the coronavirus kind of updates worldwide, there's kind of a time measurement of how many days we're behind Italy, because Italy got hit hard. And so we still, and I don't know how many days behind we are, 10 days, 9 days, but we still, and they shut down everything in Italy, in northern Italy. Like, they did a complete shutdown. I believe Spain's doing the same thing. I'm here in Kirkland, 3.1 miles from Life Care. Everything is not shut down. I was at a pretty big um, park yesterday with my two little ones. I saw old people out. I mean, with walkers. I mean, I'm like, they're going to be dead in 2 weeks. So I think region by region is going to handle it differently. I've been told by some people, my old home down in the Bay Area, that they're taking it much more serious than people in Seattle. Um, so this is really going to be a region to region thing. And the thing about hospital beds and ICU beds, you can't outsource those guys, right? The Seattle area, they're not sending people to Spokane. Like it's the Seattle area, like that's it. Seattle, Tacoma, that greater area, borders shut down. It comes down to hospital beds and ICU beds. That's the whole measurement. So, what's the takeaway? Learn to visualize, get trained to visualize, right? We get hijacked by, I got to get Boeing because it's got a great dividend or it's been around, or I got to get ExxonMobil. Have you seen the dividend on ExxonMobil? Guys, I could pull up a price chart of ExxonMobil, which I think the dividend on ExxonMobil is 10%. Guarantee you people were buying that thing when it was at 6, 7, and 8% because they were chasing dividend because they were never trained how to think visually. Well, Exxon's down 50%. That's 50. So that 8% dividend just cost them 50% of what they put in there. But it doesn't have to be that way, guys. There's a better way to invest. And what a great time to invest some money into that training, right? The average person who takes the training is over the age of 50, has $500,000 or more in the market. And they're really saying to themselves, I've got to do something. I've got to do something. I've got to do something about this. My advisor's saying just ride it out. Something seems wrong with that. That's not okay anymore. Maybe it was okay at 48, but it's certainly not okay at 60. And so there is a better way to invest where you do not have to take those big hits, where your over diversification is eliminated. And because you eliminate, you can actually make more money. So the step to do that is super easy, guys. Just go over to fearlesswealth.com, apply, and we'll get on the phone and we'll see if we're fit for the training. I'm so thankful you guys are in my world. Thank you for that. Again, my name is RC Peck, and this is just another step in helping you protect your portfolio and your future. All right, guys, take care.